The secured loan technique involves three key components to work. First, find a lender that reports the unsecured loan, which nearly all of them do. Second, you must repay at least 90% of the money borrowed right away and make minimum payments from that point forward to keep the loan payments showing in a credit history as long as possible. Lastly, the terms of the loan must be favorable and have no unexpected fees for paying it off too early. Thanks to YouTube user Daniel for reaching out and requesting this video. The premise behind the secured loan technique is to get a credit account, in this case it's a loan, to show in a credit history for as long as possible with a low balance and very little interest or other miscellaneous fees attached to it. This covers two very important aspects to a credit score: payment history and credit utilization. The longer the account shows payments reported, the more it pads the payment history factor. Prepaying the original loan balance down to below 90% ensures the credit utilization factor remains low. Get that first balloon payment in right away, because once it shows in a credit history, the difference will be night and day when other lenders see a much lower balance reported. Both these factors comprise a whopping 65% of a credit score. So it makes sense for anyone looking to start or rebuild their credit history to get familiar with the secured loan technique. The first component mentioned earlier is almost a given because nearly all lenders report installment accounts like loans. Don't confuse the term secured loan technique with a secured loan because they are two different things. One is a useful tool for consumers to inflate their score. The other is a type of loan that requires borrowers to put up collateral to secure a loan. This video discusses using unsecured loans. The second component is another obvious requirement for borrowers who practice using the secured loan technique because nearly all of the borrowed funds are required to be returned immediately. It may sound weird, but all that's happening is the borrower is asking for the money and giving most of it back right away. By paying the money back immediately, the interest the lender stands to recoup is severely reduced, almost to nearly nothing in some cases. Many lenders frown at this practice because they expect to make money when administering a loan, not to mention the additional risk involved when issuing unsecured loans. Lenders expect some return on their efforts. This brings up the last component of the secured loan technique, which is to review the terms of the unsecured loan. Origination fees, prepayment penalties, and the interest rate are the three phrases to look for when using the secured loan technique. Some lenders may disguise their fees under other keywords like administration fees and such. So if a borrower didn't want to read the entire terms and conditions of the loan contract, the lender can always state that full terms and conditions were disclosed to the borrower before the contract was signed. In other words, the onus of responsibility falls on the borrower to know what they're getting into. One way around this red tape before signing a loan is to say to the lender,
"Okay, I have your money and want to pay you back in full immediately. How much should I write out the check for the payoff amount so the account is zeroed out and closed?"
Then request an itemized receipt which will show the various additional fees outlaying how the lender arrived at their payoff amount. This will tell you what tricks the lender has up their sleeve when you're ready to prepay ahead of schedule. Finding a lender with agreeable terms is a bit harder in the 2020 decade. The total fees and interest when spread out over the entire length of the unsecured loan term should be whatever the borrower deems reasonable. In years past, some credit unions would offer unsecured loans without batting an eye at borrowers who wanted to prepay their loan balances to near zero right away. You'll have to scour the interwebs to find this information because lenders are updating their criteria for loan candidates and loan terms all the time. Some additional things to know about the secured loan technique is that the amount borrowed can favor a borrower's approval odds and terms with other lenders in the future once the current loan is paid off. Some lenders don't just want to see timely payments on loans in a credit history. Some will analyze what the original amount of the loan was because paying off a $500 unsecured loan is much easier than paying off a $30,000 loan. So if you're in the market for a new car that costs $40,000 or a student loan from the private sector to supplement your FAFSA funds to cover your remaining $50,000 college tuition, lenders won't be as favorable if a borrower's credit history shows a couple $500 loans as they would if that same borrower had one $30,000 unsecured loan. I've used Discover for this very purpose and have received 5-figure loans from them in the past, only to turn around and pay back most of the original balance within days. I'll stretch the remaining balance out for at least a couple years and often pay just a few dollars a month in interest when the total cost is averaged out over the entire term length. I understand not everyone has access to a lender that offers great interest rates and terms, so another option is to use credit builder loans. I made a video covering credit builder loans and how you don't need a credit history to open one to start your own credit history. If you have any questions or experience with the secured loan technique or credit builder loans, hit me up in the comments anytime. What are you waiting for? And thanks again to YouTube user Daniel for reaching out. You're the reason I made this video. Hit it, Steve.
Wow.